This side-by-side graph compares the flat 1 to 2% annual growth of a standard bank savings account against the steep, compounding 7 to 10% average growth of the stock market. Over a few decades, that gap represents the difference between a stagnant nest egg and a multiplying fortune. Despite these returns, millions of people stay on the sidelines, blocked by a dense wall of specialized language. Looking at a trading screen often feels like staring at a foreign code of PE ratios, dividend yields, and Fibonacci retracements. When the language feels inaccessible, investors often fall into an emotional trap called FOMO, the fear of missing out. They see a ticker symbol trending online and pour their savings into hyped assets without understanding how those businesses actually generate value. If you strip away the screens and the rapid-fire ticker tape, the core thesis is straightforward. A stock represents a legal fractional unit of ownership in a real-world company. To master the mechanics of the global market, we have to look past the data points. We need to examine how a single, relatable small business builds its foundation. Imagine a local founder who needs $100,000 to expand their storefront. They have half the cash, but they want to avoid the fixed monthly burden of a high-interest bank loan. Instead of borrowing, they choose to issue equity. They divide the total value of the company into 10 equal shares and sell the remaining 5 slices to private investors to raise the capital. An investor who buys one of those shares becomes a shareholder. As the total valuation of the business grows, the investor's individual slice expands in exact proportion. If they sell that larger slice later, they've made a profit called a capital gain. Of course, ownership carries risk. If the business fails to compete and the overall valuation drops, those individual shares compress in value. Selling a share for less than the purchase price results in a capital loss. This micro-scale dynamic of risk, reward, and fractional ownership is the exact mechanism driving every transaction in the global stock market. When a company needs massive capital to expand across the country, it moves from a private circle of investors to the public market. It lists itself on an exchange like the one seen here. Once public, the company typically issues common stock. This gives investors the right to vote on board members and provides the highest potential for long-term growth as the business expands. Some investors prefer preferred stock. They give up their voting rights in exchange for priority. They receive fixed, reliable dividend payouts before any common shareholders see a cent of the profit. Proving this fractional ownership once required physical evidence. Investors held paper certificates, like this one from 1918, which used official corporate seals to document the exact number of shares owned. The stock exchange acts as a centralized clearinghouse. On floors like this, buyers and sellers negotiate in real time to agree on the value of these ownership claims based on current supply and demand. An initial public offering, or IPO, opens the gates. It transforms a localized private business into an asset that any individual with a brokerage account can own. To measure the total size of a public company, investors use market capitalization. As shown in this diagram, you simply multiply the current share price by the total number of shares in existence. To check if that price is a bargain, investors look at the PE ratio, which compares the stock price to the company's actual earnings. It helps determine if you are paying a fair price for every dollar of profit the company generates. When you're ready to buy, a broker executes the trade. You can use a market order to buy immediately at the best available price, or a limit order to set a strict maximum you are willing to pay. You can also set a stop-loss order as a safety net. If the stock price drops to a specific trigger point, your broker automatically sells the position to prevent a total financial collapse. These prices move on cycles of emotion. A bull market is driven by widespread optimism and rising prices, while a bear market is defined by fear and declining values. These valuation metrics and order types are the rational tools investors use to navigate the psychological swings of the global marketplace. Success starts with defining your risk tolerance. It's the line that separates a day trader looking for a quick win from a long-term investor focused on steady, multi-year growth. This approach is the hallmark of value investing. By holding ownership in fundamentally strong companies for decades, compound interest does the heavy lifting. Many investors anchor their portfolios with blue-chip stocks. These are shares in industry leaders, like the one represented by this vintage delivery truck, that have a history of weathering recessions and paying consistent dividends. The golden rule of risk management is diversification. By spreading your money across different industries, you ensure that the failure of a single business doesn't wipe out your entire life savings. This diagram shows how an exchange-traded fund, or ETF, works. It bundles hundreds of different companies into one single basket, giving you instant diversification through a single trade. With this vocabulary in place, the market stops looking like a chaotic wall of numbers. It becomes a map, helping you move from someone who simply pays for products to someone who owns a piece of the companies making them.